Home Equity Loans, your guide to owning a home and accessing the money from it too. Hi, I'm Amol Heda with Keller Williams Bay Area Estates and author of Thriving Through Ownership. I came here to the US and bought my first home with just $25,000 as down payment. Those days, the rates were 8.25 for just a 5-year arm. I know we feel the interest rates are jacked up or whatever, but that was 8.25 for just a 5-year arm back in 2000. And then I got that home for $25,000 of my money, $388K. It grew to $525 and I sold it in 2005. I took $167,000. I have told this story in my previous episodes about how to buy a home with little or no money down and things like that. But now, our homes here in the Bay Area have gone from the $1 million purchase price to anywhere between $2 and $3 million. So guess what? Yes, for buyers, that's a nightmare. But for those who have already bought, that's an amazing news. You made $1 million to $2 million on just $200,000 down payment. Gosh. So, you must have heard of the popular slogan, house rich, cash poor. So you're living in a $3 million home, but you don't have money if you really needed to do something else. If you wanted to buy another property, or if you wanted to upgrade to another home. Because this home has only a $800,000 loan, your own $200,000, and the current home price is $3 million. So you have $2,200,000 plus whatever you paid down stuck under this home. With that much money stuck under the home, how are you going to do anything like upgrade into a new property or invest into another property or just take this money and spend? So here is the good news and here is how to handle that. And that's what I'm dedicated this episode to. You can borrow against the equity, meaning your down payment is your own money, which is equity. You need at least 20%. And your home went from $1 million to say $2 million. We are just going to take the smaller example. So you made $1 million of appreciation and 200 that you originally deposited as down payment is also your money. So now you have $1.2 million out of the $2 million of the home value as your own money. Just that it's in the house, in the home. You're living in a $2 million home today, but you don't have that $1.2 million that you put in. So you can borrow against this equity, which most people don't know, by paying interest. Of course, you have to pay interest. So, have you ever heard the slogan, have the cake and eat it too? This is the only perfect example of how that works. You will own the home, you will live in it, you will enjoy it, you control what you are going to make out of it. By how much did you pay? Only 20% or $200,000 out of the $1 million. The home is appreciating, say, given the Bay Area housing market, the average is about 7%, just like the S&P. But the 7% appreciation is going to be on the $1 million. So with just $200K of your money, you're controlling $1 million. And you made $1 million in say the last 5 or 7 years. So how much is your own money in that home? 1.2 million. So let me explain. What you can do is you can go to a lender, a bank, a credit union, or whoever will be willing to give you that money and borrow against the home. When you borrow money against the home, you will start paying interest. There are 2 types of loans that you can get, or rather 3 types of loans. One is a cash out refinance, meaning you can increase your current loan or mortgage balance. Say you bought the home for $1 million. You had the loan at $800,000. It went up to $2 million. You could borrow 75% of that Out of the million that you paid for the home, 800 was your loan. You kept paying down some. So say your current loan is $700,000 and you made $1 million in appreciation. So $1,300,000 is your own money. Now what the lender does is it takes your current home value, $2 million, gives you say 75% of it. When they give you 75% of it, you're getting ability to borrow $1.5 million against the home. But your current loan balance is only $700,000. So you can get $800,000 out and put it in your pocket. You're going to pay interest, but that's your own money. And if you invest this into something else that is making money, say into another business, this becomes your business expense. And so that business expense results in reduction in profit and you don't pay taxes on it. So just like your first interest on the first $750K is tax deductible, even this interest is tax deductible. Go talk to your tax consultant about that. Okay? Next, the second type of loan that you can get is a home equity loan. Again, it's just like this cash out refinance, is it will give you the best rate available on the market because you're just increasing your loan by that much. And say if you're paying a 30-year fixed, you're paying only a fixed monthly installment, not like a credit card, the rate keeps jumping. A home equity loan is like a second or piggyback loan. The advantage of a home equity loan is, suppose you got your main loan for the 800K for only 2 or 2.5% like people did just now, a year or two back, that loan remains intact. And this piggyback loan comes in a second position. And this loan, it's in addition to the first. This second loan will have a higher interest rate. It will be just like the same, like the first one. Keep making fixed payments every month. You cannot reduce the balance or increase the balance. So that's the second type of loan. The third type of loan that you can mortgage, that you can get against your home, is home equity line of credit. Home equity line of credit is awesome. Keeps your original first loan untouched, just like what I told you about the home equity loan. And home equity line of credit is like a credit card. You can use it when you want, you can pay it back when you want, and you can leave it there if you don't need it. Maybe depending on the lender that you work with, you'll pay annual service charges on it, but most people, they don't even pay those. So go check with the right lender who will give you the best program. So home equity line of credit is by far very good. So now you can get a cash out refinance, increase the entire loan amount, paying the monthly. That you could do in the last 9 months. About a year back, when interest rates were completely low, if borrowed from that would work. Equity loan leaves your first loan intact and gives you a piggyback, second or third, whatever position loan that you get. And line of credit is completely flexible, leaves your first loan intact, but payments are completely flexible. You could do interest only, you could do monthly minimum, and you could pay down the entire amount, depending on how your financial situation dictates. Only disadvantage of the home equity line of credit is it is the costliest loan and it keeps varying with the market. Now the interest rates are 7.5%. Guess what the home equity line of credit will be? 7.5 to 9%. So that's in the mortgage industry, the home equity line of credit is the costliest one. It gives you the flexibility. Depending on how you want that money, depending on where you're using it, depending on how long you need that money, you can choose one or the other. Hope this was helpful. And if you are thinking of investing, or if you are thinking of borrowing more money from these homes, use it for yourself. Sure, use one of these options. This was helpful. Thanks for watching. Bye.